Question 1. Risk assessment procedures indicate a client in Ontario, Canada, is considering an investment in a direct participation program that utilizes significant capital assets. The client has asked for clarification on how depreciation affects their taxable income from this investment, specifically questioning if it represents an actual cash outflow from the program each year. Which of the following best describes the correct understanding of depreciation in this context? Option A. Depreciation is a cash expense that directly reduces the immediate cash distribution received by the investor from the direct participation program. Option B. Depreciation is a non-cash expense allowed under the Income Tax Act, Canada, based on the entity's cost of capital assets, reducing taxable income without an immediate cash outflow. Option C. Depreciation deductions are only available for capital assets that have been fully paid for in cash by the direct participation program. Option D. Depreciation is a deduction that investors can choose to claim each year based on their personal tax bracket and desired tax reduction. The correct answer is B. Depreciation is a non-cash expense allowed under the Income Tax Act, Canada, based on the entity's cost of capital assets, reducing taxable income without an immediate cash outflow. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a representative to understand the nuances of tax deductions for direct participation programs, DPP, in Ontario, Canada, specifically concerning non-cash deductions like depreciation. Misinterpreting these rules can lead to providing incorrect advice to clients, potentially resulting in significant tax liabilities and regulatory penalties for both the client and the representative. The representative must navigate the Income Tax Act, Canada, and relevant provincial tax guidelines to ensure compliance. Correct approach analysis. The best professional practice involves accurately explaining to the client that depreciation is a non-cash expense allowed under the Income Tax Act, Canada, for certain capital assets used in a business. This deduction is based on the entity's cost of the asset and is claimed over its useful life, reducing taxable income without an actual cash outflow in the current period. This aligns with the principles of tax accounting and is a fundamental aspect of understanding DPP investments. Incorrect approaches analysis. One incorrect approach is to state that depreciation is a cash expense that directly reduces the immediate cash distribution from the DPP. This is incorrect because depreciation is a non-cash accounting concept. It reduces taxable income, which indirectly affects cash flow by lowering tax payments, but it is not a direct cash outflow from the investment itself. This misrepresentation violates the duty to provide accurate information about the investment's tax implications. Another incorrect approach is to suggest that depreciation deductions are only available for assets that have been fully paid for in cash. This is a misunderstanding of depreciation rules. Depreciation can be claimed on the cost of an asset, regardless of the financing method used to acquire it, as long as the asset is used in the production of income. Failing to recognize this can lead to clients missing out on legitimate tax benefits. A further incorrect approach is to advise the client that depreciation is a deduction that can be arbitrarily chosen by the investor each year based on their current tax bracket. Depreciation is calculated based on specific rules and prescribed rates outlined in the Income Tax Act, Canada, and is not discretionary. Misleading a client about the nature of this deduction constitutes a failure to adhere to regulatory requirements for accurate tax advice. Professional reasoning. Professionals should always prioritize a thorough understanding of the specific tax laws applicable to the investment products they recommend. In Ontario, this means consulting the Income Tax Act, Canada, and any relevant provincial tax interpretations. When explaining complex tax concepts like depreciation in DPPs, representatives must focus on accuracy, clarity, and compliance with tax legislation. They should be able to articulate the non-cash nature of depreciation and its basis in the asset's cost and useful life, ensuring clients make informed investment decisions based on correct information. Question 2. The control framework reveals that a securities firm in California is considering offering a new direct participation program, DPP, structured as a limited partnership. The DPP intends to invest in oil and gas exploration projects. The firm's management is seeking guidance on the registration requirements under the Securities Act of 1933 for this offering. Which of the following represents the most prudent and compliant approach? Option A. Conduct a thorough analysis of the DPP structure, investor rights, and the nature of the underlying investments to determine if it qualifies for an exemption from registration under the Securities Act of 1933, such as Regulation D. If no exemption is clearly applicable, proceed with filing a registration statement with the Securities and Exchange Commission. Option B. Rely exclusively on the representations made by the DPP's sponsor regarding its registration status and any purported exemptions. Option C. Proceed with the offering without federal registration, assuming that if it is compliant with California state securities laws, it will satisfy federal requirements. Option D. Assume that because the DPP is structured as a limited partnership, it is automatically exempt from registration under the Securities Act of 1933. The correct answer is A. Conduct a thorough analysis of the DPP structure, investor rights, and the nature of the underlying investments to determine if it qualifies for an exemption from registration under the Securities Act of 1933, such as Regulation D. If no exemption is clearly applicable, proceed with filing a registration statement with the Securities and Exchange Commission. Explanation: the control framework reveals a common challenge in the securities industry, ensuring compliance with registration requirements under the Securities Act of 1933 when dealing with direct participation programs, DPP. The professional challenge lies in accurately classifying the nature of the DPP and its offering to determine if it qualifies for an exemption from registration or if full registration is mandated. Misclassification can lead to severe regulatory penalties, investor harm, and reputational damage. Careful judgment is required to navigate the nuances of the Securities Act of 1933 and its interpretations. The approach that represents best professional practice involves a thorough review of the DPP structure, the nature of the underlying assets, the rights of investors, and the marketing materials to ascertain if it meets the criteria for a specific exemption under the Securities Act of 1933, such as Regulation D. If no exemption clearly applies, the correct course of action is to proceed with a full registration statement filed with the Securities and Exchange Commission, SEC. This approach prioritizes investor protection and regulatory compliance by ensuring that the offering is either properly exempted or has undergone the rigorous scrutiny of the registration process, providing investors with comprehensive disclosure. An incorrect approach involves assuming that because a DPP is structured as a limited partnership, it is automatically exempt from registration. This fails to recognize that the Securities Act of 1933 defines a security broadly, and many DPPs, regardless of their legal structure, are considered securities. Relying on an assumed exemption without proper due diligence violates the spirit and letter of the Act, potentially exposing investors to unregistered securities and the issuer to significant penalties. Another incorrect approach is to rely solely on the advice of the DPP sponsor or legal counsel without conducting independent verification of the registration status or exemption applicability. While professional advice is valuable, a representative has a personal responsibility to ensure compliance. This approach abdicates that responsibility and could lead to the sale of non-compliant securities. Finally, an incorrect approach is to proceed with the offering based on the belief that everyone else is doing it, or that the DPP has been sold in other states without registration. This disregard for federal registration requirements is a serious regulatory failure. Each offering must comply with the Securities Act of 1933, and past practices or state-level compliance do not negate the need for federal registration or a valid federal exemption. The professional reasoning framework for such situations involves a systematic process. First, understand the nature of the investment product. Second, identify all potential exemptions under the Securities Act of 1933 that might apply. Third, conduct thorough due diligence to confirm that all conditions of any claimed exemption are met. Fourth, if no exemption is clearly applicable, or if there is any doubt, consult with qualified legal counsel and prepare to file a registration statement. Finally, always prioritize investor protection and regulatory compliance above all else. Question 3. Cost-benefit analysis shows that providing a client with a detailed explanation of a significant, recently discovered operational issue affecting a direct participation program, prior to its official disclosure in an amended prospectus filing with the SEC, could satisfy the client's immediate curiosity. However, In the context of the Securities Act of 1933, what is the most appropriate course of action for a registered representative in California when a client inquires about such a development? Option A. Downplay the significance of the operational issue to avoid alarming the client and suggest waiting for further updates. Option B. Advise the client that the information is material and non-public, and direct them to review the program's prospectus and any subsequent SEC filings for official disclosure. Option C. Offer a personal opinion on how the operational issue might affect the investment's long-term prospects based on the representative's industry experience. Option D. Provide the client with a summary of the operational issue, explaining its potential impact on the program's performance, as this demonstrates good client service. The correct answer is B. Advise the client that the information is material and non-public, and direct them to review the program's prospectus and any subsequent SEC filings for official disclosure. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a representative to balance the client's immediate desire for information with the legal and regulatory obligations surrounding the disclosure of material non-public information. Missteps can lead to significant civil liability for both the representative and the firm under Section 12 of the Securities Act of 1933, particularly concerning communications that may be deemed misleading or incomplete in the context of a prospectus. The representative must navigate the fine line between providing helpful context and inadvertently revealing information that could influence an investment decision before it is properly disclosed to the public. Correct approach analysis. The best professional practice involves directing the client to the official prospectus and any subsequent SEC filings that contain the material information. This approach is correct because it adheres strictly to the regulatory framework established by the Securities Act of 1933. Section 12 imposes liability for misstatements or omissions of material fact in connection with the offer or sale of securities. By referring the client to the prospectus and official filings, the representative ensures that all investors receive the same, legally vetted information simultaneously, thereby preventing selective disclosure and potential liability under Section 12. This upholds the principle of fair disclosure and protects both the client and the representative from regulatory scrutiny and civil claims. Incorrect approach is analysis. Providing the client with a summary of the new information before it is publicly filed or disseminated through the prospectus is a regulatory failure. This constitutes selective disclosure of material non-public information, which can lead to liability under Section 12, as it creates an uneven playing field for investors and may be considered a material omission or misstatement if not properly contextualized within the official offering documents. Another incorrect approach is to downplay the significance of the new information to avoid discussing it. This is ethically problematic and potentially legally risky, as it could be interpreted as an attempt to conceal material facts, leading to liability under Section 12 if the information later proves to be significant. Finally, offering a personal opinion on how the new information might affect the investment's prospects, even if based on the representative's experience, is also a failure. This constitutes providing investment advice based on non-public information, which is a violation of disclosure rules and can expose the representative and firm to Section 12 liability for making misleading statements or omissions. Professional reasoning. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. When faced with client inquiries about material developments related to an offering, the primary step is to identify whether the information is public and has been disseminated through official channels, such as the prospectus or SEC filings. If the information is material and non-public, the representative must refrain from discussing it in a way that could influence investment decisions. Instead, they should direct the client to the official offering documents and await public disclosure. This framework ensures that all communications are consistent with the prospectus and federal securities laws, mitigating the risk of civil liability under Section 12. Question 4. Cost-benefit analysis shows that a California-based technology startup is seeking to raise capital through an intrastate offering under Section 3(a)(11) of the Securities Act of 1933. The company has advertised its offering exclusively within California and has received significant interest from potential investors. What is the most prudent course of action for the company to ensure compliance with the intrastate offering exemption? Option A. Rely on verbal assurances from investors that they are California residents and intend to hold the securities. Option B. Advertise the offering only in California and assume that all purchasers will be residents, without further verification or safeguards. Option C. Obtain written representations from each investor confirming their California residency and intent to hold the security indefinitely, and implement a reasonable waiting period before issuing stock certificates. Option D. Issue stock certificates to all investors immediately upon receipt of funds, assuming that advertising within California is sufficient to ensure compliance. The correct answer is C. Obtain written representations from each investor confirming their California residency and intent to hold the security indefinitely, and implement a reasonable waiting period before issuing stock certificates. Explanation: Scenario analysis. This scenario presents a professional challenge because it requires a nuanced understanding of the interstate offering exemption under Section 3A. 11 of the Securities Act of 1933, as interpreted by the Securities and Exchange Commission, SEC, and relevant state securities laws in California. The core difficulty lies in ensuring that the offering is genuinely limited to California residents, and that the issuer takes all reasonable steps to prevent resales to out-of-state purchasers, which would invalidate the exemption. A misinterpretation or failure to implement proper procedures can lead to significant regulatory violations and legal consequences. Correct approach analysis. The best professional approach involves a proactive and comprehensive strategy to confirm residency and prevent interstate sales. This includes obtaining written representations from each purchaser confirming their California residency and intent to hold the security indefinitely, as well as implementing a reasonable waiting period before issuing certificates or allowing resales. This approach directly addresses the requirements of Section 3A. 11 by establishing a strong presumption of compliance through documented assurances and procedural safeguards designed to prevent the securities from entering the stream of interstate commerce. The SEC's guidance emphasizes the issuer's responsibility to exercise due diligence in this regard. Incorrect approach is analysis. One incorrect approach is to rely solely on verbal assurances of residency from potential investors. This is professionally unacceptable because it lacks any verifiable documentation, making it impossible to demonstrate compliance with the residency requirement. Verbal statements are easily forgotten or misrepresented, and they provide no defense against allegations of violating the exemption. Another incorrect approach is to issue stock certificates immediately upon receipt of funds without any waiting period or further verification. This fails to account for the risk that an investor might intend to resell the security to an out-of-state purchaser shortly after the initial purchase, thereby defeating the purpose of the interstate exemption. The SEC has indicated that a reasonable time must elapse to ensure the securities are not being acquired for immediate resale. A third incorrect approach is to assume that because the offering is advertised only within California, all purchasers will be residents. While advertising within the state is a necessary step, it does not guarantee that only residents will purchase the securities, nor does it address the critical issue of preventing resales to non-residents. The exemption requires more than just local advertising. It demands active measures to ensure the securities remain within the state. Professional reasoning. Professionals must adopt a decision-making framework that prioritizes regulatory compliance and risk mitigation. This involves 1. Thoroughly understanding the specific requirements of the interstate offering exemption in California, including any relevant state-specific rules or interpretations. 2. Developing and implementing robust procedures to verify investor residency and prevent interstate resales, such as obtaining written representations and imposing reasonable holding periods. 3. Documenting all steps taken to ensure compliance. 4. Consulting with legal counsel when in doubt about the application of the exemption. This systematic approach ensures that the issuer and its representatives act in good faith and with due diligence to maintain the validity of the exemption. Question 5. The risk matrix shows a proposed underwriting spread for a new technology sector offering in Ontario that is 20% higher than the average for comparable recent offerings. The issuer, a significant client, has strongly advocated for this higher spread, citing their unique market position and the perceived complexity of the deal. What is the most appropriate course of action for the underwriting firm? Option A. agree to the proposed spread, but attempt to negotiate a slightly lower spread by highlighting the potential for negative perception from the Ontario Securities Commission if the terms appear unreasonable. Option B. Justify the higher spread by including the value of potential future advisory services the firm might provide to the issuer, even if these services are not directly tied to the current offering. Option C. Conduct a detailed analysis of the proposed spread, comparing it against market data for similar transactions, assessing the specific risks and services involved in this offering, and be prepared to justify any deviation from market norms to the Ontario Securities Commission. Option D. Accept the issuer's proposed spread without further investigation, given their status as a significant and long-standing client, to maintain a positive relationship. The correct answer is C. Conduct a detailed analysis of the proposed spread, comparing it against market data for similar transactions, assessing the specific risks and services involved in this offering, and be prepared to justify any deviation from market norms to the Ontario Securities Commission. Explanation. Scenario analysis. This scenario presents a common challenge in corporate finance, specifically concerning the underwriting of a new securities offering in Ontario. The challenge lies in balancing the issuer's desire for favorable terms with the underwriter's obligation to ensure fair and reasonable terms for the investing public, as mandated by the Ontario Securities Commission (OSC) and its related rules, particularly those governing underwriting arrangements. The underwriter must navigate potential conflicts of interest and ensure the offering is structured in a way that is not misleading or unduly burdensome on the issuer, while still protecting investors. Correct approach analysis. The best professional practice involves a thorough due diligence process that critically evaluates the proposed underwriting spread and other compensation. This includes comparing the proposed terms to market standards for similar offerings, considering the complexity and risk of the transaction, and assessing the services provided by the underwriter. The underwriter must be able to justify the reasonableness of the spread and any other compensation to the OSC if questioned. This approach aligns with the OSC's Corporate Finance Policy 1.1, which emphasizes fair and reasonable terms in underwriting agreements and requires underwriters to act in the public interest. The focus is on objective justification of the compensation based on market practice and the value of services rendered. Incorrect approach is analysis. One incorrect approach involves accepting the issuer's proposed spread without independent verification, simply because the issuer is a long-standing client. This fails to meet the underwriter's obligation to ensure fair and reasonable terms, potentially leading to an excessive spread that disadvantages investors. It prioritizes client relationship over regulatory compliance and investor protection, a clear ethical and regulatory failure under OSC guidelines. Another incorrect approach is to agree to a lower spread than market norms because the issuer has significant influence and has threatened to seek other underwriters. This demonstrates undue pressure influencing the underwriter's judgment, compromising the integrity of the underwriting process. The underwriter's compensation should be based on the value of services and market conditions, not on the issuer's leverage or threats, which violates the principle of fair and reasonable terms. A third incorrect approach is to justify a higher-than-market spread by including services that are not directly related to the underwriting of this specific offering, such as future advisory services or marketing support for unrelated ventures. While some ancillary services can be factored in, the primary justification for the spread must be the direct costs and risks associated with the current offering. Overstating the value of unrelated services to inflate compensation is a misrepresentation and a violation of the spirit and letter of OSC regulations regarding fair compensation. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Understanding the specific regulatory requirements of the jurisdiction, Ontario Securities Commission in this case. 2. Conducting thorough due diligence on all aspects of the proposed underwriting, including compensation. 3. Objectively assessing proposed terms against market standards and the value of services provided. 4. Documenting the rationale for all decisions, particularly regarding compensation. 5. Maintaining independence and resisting undue pressure from issuers. 6. Consulting with legal and compliance departments when uncertainties arise. Question 6. Cost-benefit analysis shows that adhering strictly to specific exemption requirements is paramount. A representative in California is considering facilitating an investment in a direct participation program that the issuer claims is exempt from registration under Regulation AR. The issuer has provided a preliminary offering circular. Which of the following actions best ensures compliance with California securities laws and federal regulations concerning this specific exemption? Option A. Relying solely on the issuer's assertion that the offering is exempt under Regulation AR and proceeding with the sale without independent verification of the offering's qualification status or the investor's eligibility. Option B. Confirming the issuer has properly qualified the offering under either Tier 1 or Tier 2 of regulation, and verifying the prospective investor meets the specific eligibility criteria for that tier, as outlined in the offering circular and relevant rules. Option C. Treating the Regulation AR offering as equivalent to a private placement under Regulation D, and applying the same investor qualification standards as typically used for Regulation D offerings. Option D. Assuming that any investor who meets the general definition of an accredited investor under Section 2(a) 15 of the Securities Act of 1933 is automatically eligible to invest in this Regulation AR offering. Correct answer is B. Confirming the issuer has properly qualified the offering under either Tier 1 or Tier 2 of regulation, and verifying the prospective investor meets the specific eligibility criteria for that tier, as outlined in the offering circular and relevant rules. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a representative to navigate the nuances of Regulation AR, specifically the special exemptions, while ensuring compliance with the Securities Act of 1933 and the Securities Exchange Act of 1934 in California. The temptation to rely on a broad interpretation of accredited investor without verifying the specific criteria for Regulation AR offerings can lead to significant regulatory violations and investor harm. Careful judgment is required to distinguish between general accredited investor definitions and the specific requirements for issuers utilizing Regulation AR exemptions. Correct approach analysis. The best professional practice involves a thorough understanding of the specific exemption being utilized by the issuer. For a Regulation AR offering in California, this means confirming that the issuer has properly qualified the offering under Tier 1 or Tier 2 of Regulation A, and then verifying that the prospective investor meets the criteria for that specific tier. For Tier 1, this generally involves verifying that the investor is an accredited investor as defined in Rule 501 of Regulation D, or meets certain income/net worth thresholds if the offering is conducted in California. For Tier 2, the requirements are more stringent, typically requiring investors to be accredited investors as defined in Rule 501, with additional limitations on non-accredited investors. The representative must ensure the issuer has provided the necessary offering circular, and that the investor's status is documented according to the specific requirements of the chosen tier. This approach is correct because it directly addresses the regulatory framework governing Regulation AR offerings, and ensures that the representative is acting in accordance with the specific exemption being relied upon, thereby protecting both the investor and adhering to securities laws. Incorrect approaches analysis. One incorrect approach involves assuming that any investor who meets the general definition of an accredited investor under Section 2(a) 15 of the Securities Act of 1933 is automatically eligible to invest in any Regulation AR offering. This is incorrect because Regulation AR has specific tiers, Tier 1 and Tier 2, with distinct investor qualification requirements. Relying solely on the general definition, without considering the specific tier's limitations or requirements, can lead to sales to ineligible investors, violating the terms of the exemption and potentially the Securities Act of 1933. Another incorrect approach is to solely rely on the issuer's representation that the offering is exempt under Regulation AR without independent verification of the offering's qualification status and the investor's eligibility. This approach fails to uphold the representative's duty of due diligence and compliance. If the issuer has not properly qualified the offering, or if the investor does not meet the specific criteria for the chosen tier, the exemption may be invalid, exposing both the issuer and the representative to liability under federal and California securities laws. A further incorrect approach is to treat all Regulation AR offerings as identical to private placements under Regulation D. While both are exemptions, Regulation AR has specific disclosure and qualification requirements that differ from Regulation D. Assuming the same investor qualification standards apply without confirming the specific Regulation AR tier and its associated rules is a regulatory misstep. This can result in selling to investors who would not be permitted under the specific Regulation AR exemption, thus violating the Securities Act of 1933. Professional reasoning. Professionals should adopt a framework that prioritizes understanding the specific exemption being utilized by the issuer. This involves 1. Identifying the specific exemption, e.g., Regulation AR, Tier 1 or Tier 2. 2. Researching and understanding the precise investor qualification requirements for that specific exemption and tier, considering any state-specific nuances, like those in California. 3. Verifying the issuer's compliance with the exemption's offering and disclosure requirements. 4. Documenting the investor's qualification status meticulously according to the exemption's rules. This systematic approach ensures compliance, protects investors, and mitigates regulatory risk. Question 7. Strategic planning requires a registered representative in California to sign a registration statement for a new direct participation program. Before signing, what is the most prudent course of action to ensure compliance with the Securities Act of 1933 and the California Corporate Securities Law of 1968? Option A. Conduct a thorough review of the entire registration statement, including all exhibits and supporting documents, to verify the accuracy and completeness of the disclosures. Option B. Sign the registration statement based on the assurances provided by the Direct Participation Program's general partner that all information is accurate. Option C. Sign the registration statement after reviewing only the summary prospectus, as it provides the essential details for investors. Option D. Sign the registration statement without a comprehensive review, assuming the issuer's legal counsel has ensured its compliance. The correct answer is A. Conduct a thorough review of the entire registration statement, including all exhibits and supporting documents, to verify the accuracy and completeness of the disclosures. Explanation. Scenario analysis. This scenario presents a common challenge for registered representatives involved in direct participation programs, DPP. The core issue revolves around ensuring compliance with registration requirements for securities, specifically the signing of the registration statement, while navigating the complexities of DPP structures and the potential for misrepresentation or omission of material facts. The challenge lies in understanding the specific roles and responsibilities of various parties involved in the DPP offering and the legal implications of signing a document that attests to its accuracy. Missteps can lead to severe regulatory penalties, civil liability, and damage to professional reputation. Correct approach analysis. The best professional practice involves a thorough review of the entire registration statement, including all exhibits and supporting documents, to ensure its accuracy and completeness before signing. This approach acknowledges the representative's responsibility to verify the information presented to potential investors. Specifically, it entails understanding the nature of the DPP, the rights and obligations of the limited partners, the tax implications, the management structure, and the risks involved. By diligently reviewing these aspects, the representative confirms that the disclosures are not misleading and that all material information required by the Securities Act of 1933, as interpreted by the U.S. Securities and Exchange Commission, SEC, for offerings in California, has been provided. This proactive verification is crucial for upholding the integrity of the offering and protecting investors. Incorrect approaches analysis. Signing the registration statement without a comprehensive review, relying solely on the issuer's representations, is professionally unacceptable. This approach fails to meet the due diligence requirements mandated by securities laws. It creates a significant risk of inadvertently signing off on inaccurate or incomplete information, which could lead to violations of anti-fraud provisions under federal securities laws and California state securities laws, the Corporate Securities Law of 1968. Signing the registration statement after only reviewing the summary prospectus is also insufficient. While the summary prospectus is intended to provide a concise overview, it is not a substitute for the detailed information contained within the full registration statement and its exhibits. Omitting a review of the complete documentation means the representative cannot be assured that all material facts, including potential risks and conflicts of interest, have been adequately disclosed, thereby violating disclosure obligations. Signing the registration statement based on the assurance of the DPP's general partner or sponsor without independent verification is another failure. While the general partner has primary responsibility for the offering's details, the registered representative signing the statement also bears a degree of responsibility for its accuracy. Blindly accepting assurances without due diligence exposes the representative to liability if the information provided by the general partner proves to be false or misleading. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes thoroughness and verification. This involves 1. Understanding the specific regulatory requirements applicable to the offering in the relevant jurisdiction, in this case, federal securities laws and California state laws. 2. Conducting comprehensive due diligence on the offering, including a detailed review of the registration statement and all supporting documents. 3. Identifying and assessing all material risks and disclosures. 4. Seeking clarification or additional information from the issuer or legal counsel if any aspect of the offering is unclear or appears incomplete. 5. Only signing the registration statement when fully confident in its accuracy and completeness. Question 8. The efficiency study reveals that a new direct participation program is being considered for distribution by a dealer firm in Ontario. The manager is tasked with overseeing the due diligence process for this offering. Which of the following represents the most appropriate course of action for the manager to ensure compliance with regulatory requirements and protect investor interests? Option A. Expedite the due diligence process to facilitate a swift distribution, focusing primarily on meeting internal sales targets for the new offering. Option B. Accept the sponsor's assurances regarding the program's viability and suitability, proceeding with distribution based on the sponsor's reputation. Option C. Conduct a thorough review of the DPP's offering documents, the sponsor's history, and the program's financial projections, assessing its alignment with the firm's due diligence policies and the typical risk profiles of the firm's Ontario client base. Option D. Distribute the DPP to clients whose investment profiles generally align with the program's stated objectives, without conducting an independent assessment of the program's specific risks and merits. The correct answer is C. Conduct a thorough review of the DPP's offering documents, the sponsor's history, and the program's financial projections, assessing its alignment with the firm's due diligence policies and the typical risk profiles of the firm's Ontario client base. Explanation. The efficiency study reveals a need to reevaluate the dealer's due diligence process for a new direct participation program, DPP, being offered in Ontario. This scenario is professionally challenging because the dealer's manager is responsible for ensuring that the firm's sales practices comply with regulatory requirements, particularly concerning the suitability of investments for clients and the integrity of the distribution process. The manager must balance the firm's business objectives with the paramount duty to protect investors. The best approach involves a comprehensive review of the DPP's offering documents, the sponsor's track record, and the program's financial projections, coupled with an assessment of the program's alignment with the firm's established due diligence policies and the typical risk profiles of the firm's client base in Ontario. This approach is correct because it directly addresses the core regulatory obligations under Ontario securities law and IIROC rules, now CSA oversight, for dealers to conduct thorough due diligence before recommending or distributing any investment product. It ensures that the firm understands the risks and potential rewards of the DPP and can adequately assess its suitability for its clients. This proactive and thorough review is essential for fulfilling the dealer's gatekeeping function and protecting investors from unsuitable or fraudulent offerings. An incorrect approach would be to rely solely on the sponsor's representations without independent verification. This fails to meet the dealer's obligation to conduct due diligence, potentially exposing clients to undisclosed risks and violating regulatory expectations for independent assessment. Another incorrect approach is to proceed with the distribution based on the assumption that the program is suitable because it is being offered by a reputable sponsor, without a specific analysis of how this particular DPP fits the firm's client base in Ontario. This overlooks the critical step of matching the product's characteristics to investor profiles and regulatory suitability standards. Finally, An incorrect approach would be to prioritize the speed of distribution over the thoroughness of the due diligence process, especially if the manager feels pressure to meet sales targets. This demonstrates a failure to uphold the fiduciary duty owed to clients and a disregard for regulatory compliance, which mandates that investor protection is paramount. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves 1. Understanding the regulatory landscape and specific obligations related to DPPs in Ontario. 2. Establishing clear, documented due diligence procedures. 3. Critically evaluating all aspects of an offering, including the sponsor, the product structure, and the financial viability. 4. Assessing the suitability of the product for the firm's client base. 5. Documenting the due diligence process and the rationale for proceeding with or rejecting an offering. Question 9. Strategic planning requires a registered representative in California to recommend a direct participation program, DPP, to a client. The representative has received marketing materials highlighting significant projected returns and tax benefits, and the program sponsor has provided a summary of the management team's experience. What is the most prudent course of action for the representative to ensure compliance with suitability requirements and ethical obligations? Option A. Accept the sponsor's self-reported performance data for past programs without further independent verification. Option B. Rely on the projected returns and tax benefits presented in the marketing materials, assuming the sponsor's summary of management experience is sufficient. Option C. Conduct a comprehensive review of the management team's prior performance in similar DPPs, including any regulatory actions or disciplinary history, and compare this to the program's stated objectives and risk disclosures. Option D. Focus primarily on the potential tax advantages of the DPP, as this is often a key driver for investors in such programs. The correct answer is C. Conduct a comprehensive review of the management team's prior performance in similar DPPs, including any regulatory actions or disciplinary history, and compare this to the program's stated objectives and risk disclosures. Explanation: this scenario is professionally challenging because it requires a representative to balance the potential benefits of a direct participation program, DPP, with the critical need to ensure the investment is suitable for the client, given the management's track record. The representative must navigate the inherent risks associated with DPPs, which are often illiquid and complex, and assess whether the proposed program's management has demonstrated the competence and integrity necessary to justify the investment. This requires a deep dive into the management's background and prior performance, going beyond superficial marketing materials. The best approach involves a thorough due diligence process that meticulously examines the management team's experience, their history with similar DPPs, and any regulatory actions or disciplinary history. This includes scrutinizing past performance data, understanding the strategies employed, and assessing the alignment of the management's interests with those of the investors. This approach is correct because it directly addresses the FINRA Rule 2111 suitability requirements, which mandate that a broker-dealer must have a reasonable basis to believe that a recommended investment or strategy is suitable for a particular customer based on the customer's investment objectives, risk tolerance, and financial situation. Furthermore, it aligns with the ethical obligation to act in the customer's best interest, which necessitates a comprehensive understanding of the investment's underlying risks and the competence of its management. An approach that relies solely on the program's projected returns and the promoter's assurances is professionally unacceptable. This fails to meet the suitability standard by neglecting the critical assessment of management's capabilities and past performance, thereby exposing the client to undue risk. It also violates the ethical duty of care by prioritizing potential gains over a prudent evaluation of risk and management competence. Another unacceptable approach is to accept the management's self-reported performance data without independent verification or critical analysis. This is a failure of due diligence and can lead to misrepresentation, as self-reported data may be biased or incomplete. It also ignores the potential for conflicts of interest and the need for objective assessment. Finally, an approach that focuses only on the tax benefits of the DPP, while potentially a factor for some investors, is insufficient on its own. Suitability requires a holistic view of the investment, including its economic viability and the competence of its management, not just its tax implications. Overemphasizing tax benefits without a thorough understanding of the underlying investment and its management can lead to unsuitable recommendations. Professionals should employ a decision-making framework that prioritizes client interests and regulatory compliance. This involves a systematic process of information gathering, risk assessment, and suitability determination. Before recommending any investment, especially complex ones like DPPs, representatives must 1. Understand the client's financial situation, investment objectives, and risk tolerance. 2. Conduct thorough due diligence on the investment product itself, including its structure, risks, and potential returns. 3. Critically evaluate the management team's background, experience, and track record, seeking objective evidence of their competence and integrity. 4. Document all findings and the rationale for the recommendation. Question 10. The assessment process reveals that a representative in Ontario, Canada, is evaluating a direct participation program, DPP, for a prospective client. The DPP is projected to generate the following net cash flows over its 5-year life. Year 1, $15,000, year 2, $20,000, year 3, $25,000, year 4, $30,000, and year 5, $40,000. The initial investment is $100,000. The representative believes an appropriate discount rate reflecting the risk of this DPP is 10%. What is the net present value NPV of this DPP rounded to the nearest dollar? Option A, $130,000. Option B, $25,962. Option C, $100,000. Option D, $30,000. The correct answer is B, $25,962. Explanation. The assessment process reveals a scenario that is professionally challenging due to the inherent complexity of calculating the net present value NPV of a direct participation program, DPP, in Ontario, Canada, which requires careful consideration of future cash flows, discount rates, and tax implications. Miscalculations can lead to significant financial misrepresentations and potential regulatory violations under Ontario securities law. The correct approach involves accurately projecting all future cash inflows and outflows, including initial investment, operating income, capital expenditures, and eventual sale proceeds, and then discounting these future cash flows back to their present value using an appropriate discount rate that reflects the risk of the investment. This method, when applied correctly, provides a scientifically sound valuation that aligns with the principles of financial analysis and investor protection mandated by the Ontario Securities Commission (OSC). The calculation would follow the standard NPV formula: \NPV equals \sum t equals 0 n \frac CFT 1 plus RT where CFT is the net cash flow at time T R is the discount rate, and N is the number of periods. This approach is correct because it adheres to established financial valuation principles and ensures that investors receive a realistic assessment of the potential return on their investment, thereby fulfilling the representative's duty of care and compliance with OSC regulations regarding fair dealing and accurate disclosure. An incorrect approach would be to simply sum the projected future cash flows without discounting them. This fails to account for the time value of money, meaning that future dollars are worth less than present dollars due to inflation and opportunity cost. This omission would result in an inflated and misleading valuation, violating the OSC's requirement for accurate and not misleading representations. Another incorrect approach would be to use a discount rate that is significantly lower than the perceived risk of the DPP. This would artificially inflate the NPV, again leading to a misrepresentation of the investment's potential return. Such a practice would contravene the OSC's rules against misrepresentation and the duty to act in the best interests of the client. A further incorrect approach would be to exclude certain anticipated costs, such as management fees or potential tax liabilities, from the cash flow projections. This selective omission would create an overly optimistic NPV, failing to provide a complete and accurate picture of the investment's potential profitability, and violating the principles of full disclosure under Ontario securities law. Professionals should employ a decision-making framework that prioritizes accuracy, completeness, and adherence to regulatory requirements. This involves 1. Thoroughly understanding the specific terms and projected performance of the DPP. 2. Identifying all relevant cash inflows and outflows, including taxes and fees. 3. Selecting an appropriate discount rate that reflects the investment's risk profile. 4. Performing the NPV calculation meticulously using the standard formula. 5. Reviewing the calculation for reasonableness and ensuring it aligns with disclosure obligations under Ontario securities law. Question 11. The control framework reveals that a registered representative in Ontario is preparing to distribute marketing materials for a new direct participation program. The representative has received a draft brochure from the program sponsor that emphasizes the potential tax advantages and projected returns. The representative is eager to share this with prospective investors, but is unsure about the necessary steps to ensure compliance with Ontario securities regulations. Which of the following actions represents the most compliant and professionally responsible approach? Option A. Proceed with distributing the brochure, but only after verbally confirming with prospective investors that the information presented is potentially misleading and that they should conduct their own independent research. Option B. Distribute the brochure, focusing solely on the positive aspects, and inform prospective investors that detailed risk disclosures are available upon request. Option C. Submit the draft brochure to the sponsoring dealer's compliance department for review and approval, ensuring that the prospectus or offering memorandum is also readily available to all prospective investors. Option D. Distribute the brochure immediately to prospective investors, as the program sponsor has assured the representative that the information is accurate and highlights the key benefits. The correct answer is C. Submit the draft brochure to the sponsoring dealer's compliance department for review and approval, ensuring that the prospectus or offering memorandum is also readily available to all prospective investors. Explanation. Scenario analysis. This scenario presents a common challenge in the distribution of Direct Participation Program (DPP) marketing materials. The core difficulty lies in balancing the need to effectively promote an investment opportunity with the strict regulatory requirements designed to protect investors from misleading or incomplete information. A representative must exercise careful judgment to ensure all communications are compliant, accurate, and fair, especially when dealing with complex products like DPPs. The pressure to meet sales targets can sometimes create an environment where shortcuts are tempting, making adherence to control frameworks paramount. Correct approach analysis. The best professional practice involves a thorough review and approval process for all marketing materials before they are disseminated. This approach ensures that the materials are not only compliant with the rules governing the sale of securities in Ontario, but also accurately represent the risks and potential rewards of the DPP. Specifically, this means confirming that the prospectus or offering memorandum is readily available, and that any supplemental marketing materials do not contradict or omit material information from the prospectus. This proactive verification directly addresses the regulatory obligation to provide investors with all necessary information to make an informed investment decision, as mandated by securities legislation in Ontario. Incorrect approaches analysis. Disseminating materials that only highlight the potential benefits without adequately disclosing the associated risks is a significant regulatory failure. This practice is misleading and violates the principle of fair dealing, as it presents an incomplete picture of the investment. Securities regulators in Ontario require that all material risks be clearly and conspicuously disclosed. Distributing marketing materials that have not been reviewed by a registered dealer's compliance department is also a critical failure. The control framework of a registered dealer is designed to ensure compliance with securities laws. Bypassing this internal review process exposes both the representative and the firm to regulatory action and undermines the integrity of the distribution process. Relying solely on verbal assurances from the program sponsor regarding the accuracy of marketing materials without independent verification or review is insufficient. While sponsor representations are important, the ultimate responsibility for the accuracy and completeness of marketing materials rests with the registered representative and their sponsoring firm. This approach fails to meet the due diligence requirements expected by securities regulators in Ontario. Professional reasoning. Professionals should approach the distribution of marketing materials with a mindset of proactive compliance and investor protection. This involves understanding the specific regulatory requirements for the product being offered and the jurisdiction in which it is being sold. A systematic process of review, verification, and documentation is essential. When in doubt, seeking guidance from the firm's compliance department or legal counsel is always the prudent course of action. The goal is to ensure that all communications are truthful, not misleading, and provide a fair balance of potential benefits and risks. Question 12. Stakeholder feedback indicates a need to clarify prospectus delivery requirements for dealers in the secondary market. A registered dealer in California is facilitating the sale of shares of a company that has been a reporting company under the Securities Exchange Act of 1934 for over 2 years, and whose shares are actively traded on the New York Stock Exchange. What is the dealer's primary obligation regarding prospectus delivery for this transaction? Option A. The dealer must deliver a prospectus to the buyer, as all secondary market transactions require a prospectus. Option B. The dealer must deliver a prospectus because the issuer has been a reporting company for more than 90 days, but the specific exchange listing is irrelevant. Option C. The dealer is exempt from delivering a prospectus because the issuer is a reporting company and the security is listed on a national securities exchange. Option D. The dealer should only deliver a prospectus if the buyer specifically requests it. The correct answer is C. The dealer is exempt from delivering a prospectus because the issuer is a reporting company and the security is listed on a national securities exchange. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a dealer to balance the efficient distribution of securities with the fundamental investor protection mandate of providing essential disclosure documents. The dealer must navigate the specific exemptions available under Section 4(3) of the Securities Act of 1933 in the United States, understanding that these exemptions are not absolute and have conditions. Failure to comply can lead to significant regulatory penalties and reputational damage. Careful judgment is required to determine when the prospectus delivery requirement is indeed waived and when it is still mandatory, particularly in the context of secondary market transactions. Correct approach analysis. The best professional practice involves a thorough understanding of the specific transaction and the applicable exemptions. In the context of a dealer selling securities in the secondary market, the dealer must ascertain if the issuer has been subject to the reporting requirements of the Securities Exchange Act of 1934 for at least 90 days or 135 days for certain issuers, and if the security is listed on a national securities exchange or quoted on the Nasdaq stock market. If these conditions are met, the dealer is generally exempt from delivering a prospectus under Section 4(3) of the Securities Act of 1933. This approach is correct because it directly applies the conditions outlined in the statutory exemption, ensuring compliance while facilitating efficient secondary market trading. Incorrect approach is analysis. One incorrect approach is to assume that any transaction occurring after the initial public offering is automatically exempt from prospectus delivery. This fails to recognize that Section 4(3) has specific conditions related to the issuer's reporting status and the securities trading venue. Another incorrect approach is to rely solely on the fact that the security is publicly traded without verifying the issuer's reporting history. The exemption is tied to the availability of current information through SEC filings, which is not guaranteed for all publicly traded securities. Finally, an incorrect approach would be to deliver a prospectus only if explicitly requested by the buyer, without first assessing whether the Section 4(3) exemption applies. This places an undue burden on investors and bypasses the dealer's responsibility to determine their own compliance obligations. Professional reasoning. Professionals should adopt a systematic approach to determine prospectus delivery obligations. First, identify the nature of the transaction, primary or secondary offering. Second, if it's a secondary offering by a dealer, ascertain the issuer's reporting status under the Securities Exchange Act of 1934 and the trading venue of the security. Third, consult the specific provisions of Section 4(3) of the Securities Act of 1933 and relevant SEC guidance to confirm if the exemption conditions are met. If the exemption applies, no prospectus is required. If not, the dealer must ensure a prospectus is delivered. This structured process minimizes the risk of non-compliance and upholds investor protection principles. Question 13. Stakeholder feedback indicates that a registered representative in Ontario, Canada, is considering posting a brief, informal update on their professional social media account about a new investment strategy their firm is offering. The representative believes the update is too short and informal to require formal review. Which of the following approaches best aligns with the regulatory standards and required approvals for public communications in Ontario? Option A. Seek compliance approval only if the social media post includes specific performance data or projections related to the investment strategy. Option B. Submit the social media post to the firm's compliance department for review and approval before publishing. Option C. Rely on the representative's personal understanding of securities regulations to determine compliance and publish without further review. Option D. Publish the social media post immediately, as its brevity and informal nature exempt it from formal review. The correct answer is B. Submit the social media post to the firm's compliance department for review and approval before publishing. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a registered representative to balance the need to promote investment opportunities with the strict regulatory requirements for public communications in Ontario, Canada. Representative must ensure that any communication is not misleading, is fair and balanced, and has received the necessary internal approvals before dissemination. Failure to adhere to these standards can lead to regulatory sanctions, reputational damage, and harm to investors. Correct approach analysis. The best professional practice involves ensuring that the proposed social media post is reviewed and approved by the firm's compliance department before it is published. This approach is correct because under Ontario securities law, specifically the rules governing advertising and sales literature, all public communications by registered firms and individuals must be fair, balanced, and not misleading. The compliance department is responsible for verifying that the content meets these standards, including ensuring that any claims made are substantiated, risks are adequately disclosed, and the communication does not omit material facts. This pre-approval process is a critical safeguard mandated by regulatory bodies to protect investors. Incorrect approaches analysis. One incorrect approach is to publish the social media post immediately, assuming that because it is a brief, informal update, it does not require formal review. This is professionally unacceptable because it bypasses the mandatory compliance review process. Ontario securities regulations do not exempt informal or brief communications from review if they are disseminated to the public and relate to securities or investment products. This failure to seek approval risks disseminating misleading or unbalanced information, violating regulatory obligations. Another incorrect approach is to rely solely on the representative's personal understanding of securities regulations to determine if the post is compliant. While a representative must have a foundational understanding of the rules, personal judgment alone is insufficient for public communications. This approach is professionally unacceptable because it delegates the critical responsibility of ensuring regulatory compliance to an individual without the specialized oversight and expertise of a dedicated compliance function. The firm, as a whole, is responsible for the communications of its representatives, and this approach fails to implement the necessary internal controls. A further incorrect approach is to only seek approval if the post contains specific performance data or projections. This is professionally unacceptable because regulatory requirements for fair and balanced communications extend beyond just performance figures. Any public communication that could influence an investor's decision, even if it doesn't contain explicit numbers, must be reviewed for potential misleading statements, omissions of material facts, or an unbalanced presentation of risks and benefits. This selective approach to compliance review is a significant regulatory failure. Professional reasoning. Professionals should adopt a proactive and diligent approach to public communications. This involves understanding that all public communications, regardless of their format or perceived informality, are subject to regulatory scrutiny. The decision-making process should prioritize obtaining internal compliance approval for any material intended for public dissemination. This ensures that the communication is reviewed by individuals with the specific expertise to assess its compliance with all applicable securities laws and regulations, thereby mitigating risk for both the representative and the firm, and most importantly, protecting investors. Question. Stakeholder feedback indicates that a registered representative in Ontario, Canada, is considering posting a brief, informal update on their professional social media account about a new investment strategy their firm is offering. The representative believes the update is too short and informal to require formal review. Which of the following approaches best aligns with the regulatory standards and required approvals for public communications in Ontario? Options: A. Submit the social media post to the firm's compliance department for review and approval before publishing. B. Publish the social media post immediately, as its brevity and informal nature exempt it from formal review. C. Rely on the representative's personal understanding of securities regulations to determine compliance and publish, without further review. D. Seek compliance approval only if the social media post includes specific performance data or projections related to the investment strategy. Question 14. Governance review demonstrates that a California-based broker-dealer is preparing to participate in a private placement offering structured under Section 4A. 5 of the Securities Act of 1933, which is intended to be offered solely to accredited investors. The representative is tasked with ensuring the offering's compliance. Which of the following actions best ensures adherence to regulatory requirements for this specific offering in California? Option A. Accept verbal assurances from potential investors that they meet the definition of an accredited investor without seeking further corroboration. Option B. Implement a rigorous process to verify each prospective investor's accredited status through documentation or reliable representations that align with federal definitions and any applicable California regulations. Option C. Assume all investors in the private placement are accredited due to the offering's marketing as such. Option D. Focus solely on federal securities law compliance, assuming California's Corporate Securities Law of 1968 will not impose additional requirements for this type of offering. The correct answer is B. Implement a rigorous process to verify each prospective investor's accredited status through documentation or reliable representations that align with federal definitions and any applicable California regulations. Explanation: this scenario is professionally challenging because it requires a representative to navigate the nuances of Section 4A. 5 of the Securities Act of 1933, specifically concerning offerings made solely to accredited investors in California. The representative must ensure that the offering structure and the investor qualification process strictly adhere to federal and state regulations to avoid potential violations. Misinterpreting the definition of an accredited investor or failing to properly document their accredited status can lead to significant legal and regulatory repercussions. The correct approach involves meticulously verifying that each prospective investor meets the federal definition of an accredited investor as outlined in Rule 501 of Regulation D, and also ensuring compliance with any additional California-specific requirements for such offerings. This includes obtaining appropriate documentation or representations from the investors that confirm their accredited status. The justification for this approach lies in the explicit language of Section 4A. 5, which permits these limited offerings provided they are made exclusively to accredited investors. Federal regulations, such as Rule 506B and 506C under Regulation D, provide the framework for defining accredited investors and the requirements for conducting such offerings. California, while generally aligning with federal definition, may have specific disclosure or filing requirements that must also be satisfied. Diligent verification is paramount to ensure the offering remains exempt from registration. An incorrect approach would be to rely solely on a verbal representation from a potential investor that they are accredited without any further substantiation. This fails to meet the due diligence standards required by securities laws, as verbal assurances are not sufficient evidence of accredited status. The regulatory framework necessitates a more robust process to confirm an investor's financial sophistication and net worth or income. Another incorrect approach would be to assume that all investors in a private placement are automatically accredited simply because the offering is being marketed as such. This bypasses the critical step of individual investor verification and exposes the issuer and the representative to significant risk if an unaccredited investor participates. The exemption is contingent upon the investor's status, not the issuer's assertion. Finally, an incorrect approach would be to proceed with the offering without confirming compliance with California's specific securities laws, known as the Corporate Securities Law of 1968, which may impose additional conditions or filing requirements even for offerings made to accredited investors. Overlooking state-level regulations can render an otherwise federally compliant offering non-compliant within the state. Professionals should employ a decision-making framework that prioritizes thorough due diligence, strict adherence to regulatory definitions, and comprehensive documentation. This involves understanding the specific exemptions being relied upon, the definitions of key terms like accredited investor, and any applicable state securities laws. When in doubt, seeking legal counsel or consulting with compliance experts is a crucial step in ensuring regulatory adherence. Question 15. The efficiency study reveals that a registered dealer in Ontario, Canada, is considering entering into a new dealer agreement with the sponsor of a series of direct participation programs. The proposed agreement includes a tiered commission structure that offers significantly higher compensation to the dealer for selling a greater volume of the sponsor's products. What is the most prudent course of action for the dealer to take regarding this agreement? Option A. Accept the dealer agreement based on verbal assurances from the sponsor that the terms are standard and do not present any regulatory concerns. Option B. Sign the dealer agreement and then implement a more rigorous suitability review process for each client who expresses interest in the sponsor's direct participation programs. Option C. Submit the proposed dealer agreement to the firm's compliance department for a thorough review to identify any potential conflicts of interest and ensure compliance with Ontario securities law before execution. Option D. Proceed with the dealer agreement as presented, assuming the sponsor's offerings are suitable for clients and that the commission structure is a standard industry practice. The correct answer is C. Submit the proposed dealer agreement to the firm's compliance department for a thorough review to identify any potential conflicts of interest and ensure compliance with Ontario securities law before execution. Explanation. The efficiency study reveals a potential conflict of interest arising from a dealer's agreement with a sponsor of direct participation programs, DPP, in Ontario, Canada. This scenario is professionally challenging because the dealer must balance their fiduciary duty to clients with the financial incentives potentially offered by the sponsor through the dealer agreement. Careful judgment is required to ensure that client interests are prioritized over potential personal or firm gains. The best approach involves a thorough review of the dealer agreement by the firm's compliance department, focusing on identifying any terms that could compromise the dealer's objectivity when recommending DPPs. This includes scrutinizing fee structures, performance incentives, and any exclusivity clauses. If the compliance review identifies terms that create an unacceptable risk of conflict, the firm should negotiate with the sponsor to amend the agreement or, if amendment is not possible, decline to enter into the agreement. This approach is correct because it proactively addresses potential conflicts of interest in accordance with the Ontario Securities Commission (OSC) regulations, particularly those related to suitability and acting in the best interests of clients. It demonstrates a commitment to ethical conduct and regulatory compliance by ensuring that client recommendations are based on suitability and not influenced by the terms of the dealer agreement. An incorrect approach would be to proceed with the dealer agreement without a comprehensive compliance review, assuming that the sponsor's offerings are inherently suitable. This fails to meet the regulatory requirement to identify and manage conflicts of interest, potentially exposing clients to unsuitable investments and violating the dealer's duty to act in their best interests. Another incorrect approach is to rely solely on the sponsor's assurances that the agreement is standard and poses no issues. This abdicates the dealer's responsibility for due diligence and compliance oversight, which is a critical failure under OSC rules. The dealer cannot delegate its regulatory obligations to a third party. Finally, an incorrect approach would be to accept the agreement as is, and then attempt to mitigate conflicts on a case-by-case basis during client interactions. While individual client suitability assessments are crucial, this reactive strategy does not address the systemic risk introduced by a potentially problematic dealer agreement. It fails to proactively manage conflicts at the firm level, which is a fundamental requirement for responsible dealer operations in Ontario. Professionals should adopt a proactive risk assessment framework. This involves understanding the nature of the dealer agreement, identifying potential conflicts of interest, assessing the severity of those conflicts, and implementing appropriate controls or mitigation strategies. This framework should be embedded within the firm's compliance policies and procedures, ensuring that all agreements are subject to rigorous scrutiny before execution. Question 16. Market research demonstrates that direct participation programs, DPP, can offer unique tax advantages. A registered representative in California is considering recommending a DPP to a client. Which of the following approaches best aligns with regulatory requirements and professional ethics in California? Option A. Present the DPP as a strong income-generating opportunity, highlighting its potential for high returns while downplaying the associated risks of illiquidity and principal loss. Option B. Conduct a comprehensive review of the client's financial situation, investment objectives, and risk tolerance, ensuring the DPP's characteristics are a suitable match for the client's profile and documenting this assessment thoroughly. Option C. Emphasize the potential tax benefits of the DPP to the client, assuming that any investor seeking tax advantages will be suitable for such an investment. Option D. Recommend the DPP because it is a new and potentially profitable product being actively promoted by the firm, and the client has expressed general interest in growth opportunities. The correct answer is B. Conduct a comprehensive review of the client's financial situation, investment objectives, and risk tolerance, ensuring the DPP's characteristics are a suitable match for the client's profile and documenting this assessment thoroughly. Explanation. This scenario is professionally challenging because it requires a representative to balance the potential benefits of a direct participation program, DPP, with the inherent risks and the specific regulatory environment of California. The representative must not only understand the product, but also the client's financial situation and risk tolerance within the context of California's investor protection laws. Careful judgment is required to ensure that the recommendation is suitable and compliant. The best professional approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, specifically considering California's regulatory requirements for suitability. This includes understanding the illiquid nature of DPPs, their tax implications, and the potential for loss of principal. A representative must document this assessment meticulously to demonstrate that the DPP recommendation aligns with the client's profile and complies with California's stringent suitability standards, which emphasize protecting investors from unsuitable investments. Recommending a DPP solely based on its potential tax benefits without a comprehensive understanding of the client's overall financial health and risk capacity is a significant regulatory failure. California law, like other jurisdictions, mandates that recommendations be suitable, and focusing on a single benefit while ignoring potential downsides or the client's ability to absorb losses is a violation of this principle. Suggesting a DPP because it is a new product being offered by the firm, without adequately evaluating its fit for the client, represents a failure to prioritize the client's best interests over the firm's product offerings. This approach risks violating suitability rules by allowing firm-centric interests to influence investment recommendations. Presenting a DPP as a guaranteed high-return investment without full disclosure of the associated risks, such as illiquidity, management fees, and the possibility of principal loss, is ethically and regulatorily unsound. California regulators expect full and fair disclosure of all material facts, and downplaying risks to secure a sale is a direct contravention of these expectations. Professionals should employ a decision-making framework that begins with a deep understanding of the client's financial circumstances, objectives, and risk tolerance. This should be followed by a thorough due diligence of the investment product, including its risks, rewards, fees, and liquidity. Finally, the representative must ensure that the recommendation is demonstrably suitable for the client and fully compliant with all applicable state and federal regulations, with comprehensive documentation to support the decision. Question 17. During the evaluation of a new research report containing detailed financial projections and market analysis, a registered representative in California is preparing to distribute it. The report is intended for sophisticated investors who understand complex financial instruments and market dynamics. Which of the following approaches best aligns with regulatory requirements for communications with the public? Option A. Distribute the report to the sophisticated investor, classifying it as institutional communication. Option B. Send the report to the sophisticated investor via email, classifying it as correspondence. Option C. Post the report on the firm's public website, classifying it as a general advertisement. Option D. Distribute the report to all clients, classifying it as a retail communication. The correct answer is A. Distribute the report to the sophisticated investor, classifying it as institutional communication. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a registered representative to discern the appropriate communication method for a specific client based on their investment sophistication and the nature of the information being conveyed. Misclassifying a communication can lead to regulatory violations, client dissatisfaction, and potential legal repercussions. Careful judgment is required to balance efficiency with compliance and client protection. Correct approach analysis. The best professional practice involves accurately categorizing the communication based on the recipient's status and the content. For a sophisticated institutional investor, a detailed research report containing projections and analysis would be considered institutional communication. This approach is correct because it aligns with FINRA Rule 2210, Communications with the Public, which distinguishes between retail, institutional, and correspondence communications, and mandates different review and approval processes based on these categories. Institutional communications are subject to less stringent review requirements than retail communications, provided they are distributed only to institutional investors. Incorrect approach is analysis. Distributing the detailed research report to all clients, regardless of their sophistication, would constitute a retail communication. This is incorrect because retail communications are subject to stricter review and approval requirements by a registered principal, and distributing complex, forward-looking information to unsophisticated investors could be misleading and violate suitability obligations. Sending the report as correspondence to the institutional client is incorrect. Correspondence is defined as written communication distributed or made available to 25 or fewer existing retail customers of the member, broker, or dealer in any 30-day period. This report is intended for an institutional investor, not a small group of retail clients, and mischaracterizing it as correspondence bypasses the appropriate regulatory treatment for institutional communications. Treating the report as a general advertisement is incorrect. Advertisements are designed to attract the public and are subject to specific content and filing requirements. While a research report might indirectly attract business, its primary purpose is to provide analysis to sophisticated investors, not to solicit new retail business in a general manner. Misclassifying it as an advertisement would subject it to unnecessary and inappropriate regulatory scrutiny for its intended audience. Professional reasoning. Professionals should employ a decision-making framework that prioritizes understanding the recipient's profile, retail vs. institutional, the nature and complexity of the information being communicated, and the intended distribution method. When in doubt, it is always prudent to err on the side of caution and apply the most stringent regulatory requirements applicable to the potential audience. A thorough understanding of FINRA Rule 2210 and its definitions of retail, institutional, and correspondence communications is essential for accurate classification and compliance. Question 18. What factors determine the appropriate way for a registered representative in California to discuss the tax implications of a direct participation program with a client, given the representative's licensing limitations? Option A. The representative should interpret the tax implications of the DPP for the client and explain how these might affect their specific tax return. Option B. The representative should refuse to discuss any tax-related aspects of the DPP with the client, regardless of the client's questions. Option C. The representative should explain the general tax treatment of the DPP as outlined in the offering documents and advise the client to consult with a qualified tax professional for personalized advice. Option D. The representative should assure the client that the DPP has no adverse tax consequences for their investment. The correct answer is C. The representative should explain the general tax treatment of the DPP as outlined in the offering documents and advise the client to consult with a qualified tax professional for personalized advice. Explanation. This scenario is professionally challenging because it requires a representative to navigate the complex interplay between a client's investment objectives, the tax implications of a direct participation program, DPP, and the limitations on providing tax advice. The representative must ensure the client receives accurate information without overstepping their licensing boundaries, which could lead to regulatory violations and harm to the client. The core of the challenge lies in distinguishing between providing factual information about a DPP's tax characteristics and offering specific tax advice. The best professional approach involves clearly communicating the general tax treatment of the DPP as disclosed in its offering documents, and advising the client to consult with a qualified tax professional for personalized advice. This approach is correct because it adheres to FINRA rules and state regulations that prohibit unregistered individuals or entities from providing tax advice. By directing the client to a tax professional, the representative fulfills their duty to inform the client about potential tax consequences while respecting regulatory boundaries and ensuring the client receives expert, tailored guidance. This upholds the principle of acting in the client's best interest by facilitating access to necessary specialized advice. An incorrect approach would be to interpret the tax implications of the DPP for the client and explain how those implications might affect their personal tax situation. This is a failure because it constitutes providing tax advice, which is outside the scope of a securities representative's license and regulatory authority. Such an action could lead to misinterpretations by the client and potential liability for the representative and their firm if the advice proves inaccurate or unsuitable. Another incorrect approach is to state that the DPP has no tax implications whatsoever, without qualification. This is a failure because it is likely an oversimplification or outright misrepresentation of the tax characteristics of most DPPs, which often have complex tax treatments, including potential passive activity, loss limitations, or at-risk rules. Failing to disclose potential tax consequences or providing misleading information violates the duty of fair dealing and can lead to significant client harm and regulatory sanctions. Finally, an incorrect approach would be to avoid discussing any tax-related aspects of the DPP, even when the client inquires, citing a general inability to discuss taxes. While caution is warranted, completely shutting down a relevant discussion can be detrimental to the client's understanding and decision-making process. A more appropriate response, as outlined in the best approach, is to provide general information from the offering documents and then refer the client to a tax professional for specific advice. Professionals should employ a decision-making framework that prioritizes regulatory compliance and client well-being. This involves understanding the scope of their license, identifying situations where specialized advice is required, and clearly communicating the limitations of their expertise to the client. When tax implications are a significant factor in an investment decision, the framework dictates that the representative should provide factual information from official documents and strongly recommend consultation with a qualified tax advisor. Question 19. Benchmark analysis indicates that a new direct participation program is generating significant interest among potential investors in California due to its projected high returns. As a representative, you are eager to present this opportunity. Under the Securities Act of 1933, what is the most appropriate course of action to ensure compliance and protect investors before any offers or sales are made? Option A. Focus marketing efforts on the potential upside and growth opportunities, while briefly mentioning that there are some risks without detailing them in the prospectus. Option B. Rely on oral presentations and informal meetings to convey the program's objectives and potential benefits, as the Securities Act of 1933 primarily governs the sale of securities, not the initial marketing discussions. Option C. Ensure that a registration statement has been filed with and declared effective by the Securities and Exchange Commission, and that a prospectus containing all material information, including risks, has been provided to potential investors. Option D. Begin marketing the program immediately, emphasizing the projected high returns and providing preliminary financial projections as part of informal discussions. The correct answer is C. Ensure that a registration statement has been filed with and declared effective by the Securities and Exchange Commission, and that a prospectus containing all material information, including risks, has been provided to potential investors. Explanation. This scenario presents a professional challenge because it requires a representative to balance the potential for investor interest in a new offering with the stringent disclosure requirements mandated by the Securities Act of 1933. The core tension lies in providing sufficient information to allow for informed investment decisions without making unsubstantiated claims that could mislead investors or violate registration requirements. Careful judgment is required to navigate the line between promotional enthusiasm and regulatory compliance. The best professional approach involves prioritizing the accurate and complete disclosure of all material information about the direct participation program, as required by the Securities Act of 1933. This means ensuring that a registration statement, including a prospectus detailing the program's objectives, risks, fees, management, and financial projections, has been filed with and declared effective by the Securities and Exchange Commission, SEC, before any offers or sales are made. This approach is correct because it directly adheres to the fundamental purpose of the Securities Act of 1933, which is to protect investors by requiring full and fair disclosure of information. By ensuring the registration statement and prospectus are complete and accurate, the representative fulfills their legal and ethical obligation to provide investors with the necessary tools to assess the risks and potential rewards of the investment. An incorrect approach would be to proceed with marketing the program based on preliminary information or projections, even if presented as potential or estimated. This fails to meet the Securities Act of 1933 requirement for a fully effective registration statement and prospectus before any offer to sell. The regulatory failure here is the premature solicitation of investment without providing the legally mandated disclosures, which can lead to investor harm and significant penalties for the representative and the issuer. Another incorrect approach would be to focus solely on the potential upside and growth opportunities of the program, downplaying or omitting any discussion of the inherent risks. While enthusiasm is important, the Securities Act of 1933 mandates a balanced presentation of both potential benefits and risks. Omitting or minimizing risks constitutes a material omission, which is a violation of the Act's disclosure requirements and can lead to misinformed investment decisions by investors. Finally, an incorrect approach would be to rely on oral assurances or informal discussions to convey critical program details, bypassing the formal prospectus. The Securities Act of 1933 emphasizes written disclosure through the prospectus. Oral representations, while potentially persuasive, are not a substitute for the comprehensive, legally reviewed information contained in the prospectus and can be difficult to prove or disprove, leaving investors vulnerable. The professional reasoning framework for navigating such situations involves a commitment to understanding and strictly adhering to the Securities Act of 1933 disclosure mandates. Representatives must proactively ensure that all offerings are properly registered and that investors receive a complete and accurate prospectus before any investment decision is made. This includes a thorough review of all marketing materials to ensure they are consistent with the filed registration statement and do not contain misleading statements or omissions. When in doubt, seeking guidance from legal counsel or compliance departments is paramount. Question 20. The audit findings indicate that the sponsor of a real estate limited partnership being registered in California has provided projected annual returns of 15% for the first 5 years, based on aggressive assumptions regarding rental income growth and property appreciation. The registration statement is currently being prepared. What is the most appropriate action for the registered representative to take regarding these projected returns? Option A. Present only the 15% projected returns in the registration statement, as these are the figures that will attract potential investors. Option B. Include the projected returns of 15% in the registration statement as provided by the sponsor, assuming the sponsor has conducted their own due diligence. Option C. Independently verify the reasonableness of the sponsor's assumptions by comparing them to industry benchmarks and historical data for similar properties, and ensure that any significant risks associated with achieving these returns are clearly and prominently disclosed in the registration statement. Option D. Advise the sponsor to revise the projections downwards to a more conservative figure, even if the original assumptions are technically defensible, to avoid any potential future disputes. Correct answer is C. Independently verify the reasonableness of the sponsor's assumptions by comparing them to industry benchmarks and historical data for similar properties, and ensure that any significant risks associated with achieving these returns are clearly and prominently disclosed in the registration statement. Explanation. The audit findings indicate a potential misstatement in the projected returns for a real estate limited partnership offered in California. This scenario is professionally challenging because it requires the representative to reconcile the sponsor's optimistic projections with the regulatory requirements for disclosure and the investor's need for realistic expectations. The representative must ensure that the offering materials accurately reflect potential risks and returns, adhering to the stringent disclosure standards set forth by the Securities and Exchange Commission, SEC, and California's securities laws, particularly concerning the preparation of registration statements for direct participation programs. The best professional approach involves a thorough review of the sponsor's financial models and assumptions, comparing them against historical performance data for similar investments and industry benchmarks. This includes stress testing the projections under various economic scenarios to assess their reasonableness. If the projections appear overly optimistic or lack sufficient supporting data, the representative must engage with the sponsor to request revisions, or to ensure that the assumptions and risks are clearly and prominently disclosed in the registration statement. This aligns with the SEC's disclosure requirements under Regulation S-K, which mandates full and fair disclosure of all material information, and the NAST Rule 2310, now FINRA Rule 2310, regarding fair dealing with customers, ensuring that recommendations are suitable and based on accurate information. The representative's duty is to present a balanced view, not to endorse unrealistic projections. An incorrect approach would be to simply accept the sponsor's projections at face value and include them in the registration statement without independent verification or critical analysis. This fails to meet the representative's obligation to ensure the accuracy and completeness of the offering documents and violates the spirit of investor protection inherent in securities regulations. Another incorrect approach is to selectively present only the most favorable projections while downplaying or omitting less favorable ones. This constitutes a misleading omission of material facts, which is a serious regulatory violation. Furthermore, relying solely on the sponsor's assurances without conducting due diligence on the underlying assumptions demonstrates a lack of professional skepticism and a failure to uphold fiduciary responsibilities. Professionals should adopt a decision-making framework that prioritizes investor protection and regulatory compliance. This involves a proactive approach to due diligence, a critical evaluation of all provided information, and a willingness to challenge assumptions and projections that appear unreasonable. When in doubt, seeking clarification from the sponsor, consulting with legal counsel or compliance officers, and ensuring that all disclosures are transparent and balanced are essential steps in navigating these complex situations. The ultimate goal is to facilitate informed investment decisions by providing investors with accurate and comprehensive information.